Heya Cryptozens. Tonight's show: Musk, Twitter, and the blockchain. SEC accuses two of pump and dump, and Texas and Vermont objects to Celsius's stablecoin sales. It's 10 p.m. Pacific. The date is September 30th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host. The cover model, mascot, and co-host for this podcast is Tex. And together, we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. I think a new social media company is needed that is based on a blockchain and includes payments. That was a text that was sent by Elon Musk. Just days later, he submitted an offer to buy Twitter for $43 billion last April. Seems like it was forever ago, but it was just April. And this was just one of many texts, 40 pages worth, covering the period from January to June of this year. Now, ultimately, Musk would withdraw his offer. And that, of course, has landed him in some hot water, because Twitter sued Musk. So he's due to give his deposition in October. There were a bunch of his texts released today, and this was in a piece published by Business Insider. And these texts themselves came out as part of the pre-trial discovery process. And so these texts are really interesting because they give us an insight into what he was thinking when he made the offer and what he was thinking when he withdrew that offer. And now it seems, reading through some of these texts, Musk wanted to save the company. He felt Twitter failed to protect the free speech of its users. And for a while, he was thinking of using the blockchain to solve the issue of free speech in a social media setting. One message to his brother Kimball read, quote, "I have an idea for a blockchain social media system that does both payments and short messages or links like Twitter. You have to pay a tiny amount to register your message on the chain, which will cut out the vast majority of spam and bots. There is no throat to choke, so free speech is guaranteed." Now, this idea may have come from a text that Musk himself received. It came from author William McCaskill, and McCaskill was talking about FTX founder Sam Bankman-Fried. He said, quote, "I'm not sure if this was what's on your mind, but my collaborator, Sam Bankman-Fried, has for a while been potentially interested in purchasing it and making it better for the world. If you want to talk with him about a possible joint effort in that direction." And then he gave SBF's number to Musk in case he was interested in working with him on that. Musk's response showed his primary concern, quote, "Does he have huge amounts of money?" McCaskill said that SBF was worth $24 billion and ready to spend between $8 and $15 billion of that on the acquisition. And it does look like they may have spoken in early April. That would be before Musk messaged his brother. Morgan Grimes of Morgan Stanley was also talking SBF up to Musk. He called him a, quote, "ultra genius and doer builder." Now, ultimately, it looks like that relationship never really got off the ground. At one point, he said that he's not interested in a, quote, "laborious blockchain debate with Sam." Now, further, neither Sam nor FTX appeared on the list of potential co-investors. There was Binance, A16Z, Fidelity, Sequoia Capital, but no FTX. Now, for his part, Kimball responded on April 9th. He said that he had dug deep on Web3 and that he was interested in using the voting powers. For him, you could crowdsource kicking scammers out by implementing some sort of voting mechanism, which, if you've been following the story, you know Musk wants to get rid of the bots and scammers. In fact, that is part of the problem, why Musk hasn't purchased Twitter, the bots and scammers. Another suggestion from Kimball was establishing a token for Twitter. This is a token that the user would have to hold in their wallet in order to post messages. Now, Kimball said it doesn't have to be an expensive amount and that it could grow over time. And on April 9th, Kimball pointed out a potential flaw for using the blockchain to power a social media platform. Quote, "Blockchain prevents people from deleting tweets. Pros and cons, but let the games begin." So that might have been a negative in Elon's eyes. He previously campaigned for the ability to edit tweets. An indelible record on the blockchain might not be appealing to him. April 9th was also the day that he tweeted Brett Taylor. Now, Brett is Twitter's chairman of the board. So Elon tweets him, basically giving him a heads up that he's going to make an offer to take the company private. Now, this was after Twitter's CEO asked Musk to stop tweeting. And that may have been the genesis of the seeming rancor between Musk and Argyle. Now, Dorsey, that's a different story. He says his biggest sin was in taking Twitter public. That and advertising. Advertising is a problem because it gives the governments and advisors kind of a hook that they can get in and try to control you. Now, his point is that if Twitter had just remained a protocol and not a company, things would be very different. On March 26th, Dorsey told Musk that a new platform would be needed, one that does away with the corporate model. That was 2 weeks before Musk submitted his offer to buy Twitter. Now, as it currently stands, these texts were released as part of pre-trial discovery in the suit that Twitter has brought against Musk. Musk says that there's too many bot accounts, that the company isn't worth it. The first hearing for this suit is scheduled to be held on October 17th. As we like to do on this show, let's take a look at the numbers. At the time of writing, the global crypto market cap is $940 billion. That's down 0.3%. The whole day has been kind of flat like this. The top 5 cryptos by market cap are Bitcoin down 0.23%, Ethereum down 0.22%, Tether, USDC, and Binance Coin up 0.33%. The U.S. Securities Exchange Commission has filed charges against 3 companies. One is Arbitrade from Bermuda, UAE-based Scion Trading, and the other is Canada's Cryptobontics. Not only did they charge the companies, but the 4 men behind them. So the SEC has charged them with carrying out a pump and dump scheme. The asset in question is Dignity, or DIG. So what happened is these 2 companies got together, and between May of 2018 and January of 2019, they claimed Arbitrade had come up with the title for $10 billion in gold bullion, and that gold would go to back this DIG token. But the SEC says that's not what happened. In reality, it was a ruse to pump DIG's demand. Then they dumped it. Dumped it by selling $36.8 million worth of DIG to U.S. investors at inflated prices. Now, the way they presented it, it was almost like a stablecoin. They said each of the 3 billion DIG tokens were covered by $1 worth of gold. And further, that you could trade those tokens in for real gold. You could only buy it from a Russian crypto exchange called Livecoin, which is kind of funny because Livecoin is dead. They shut down in January 21 due to alleged hack. So what the SEC says is that these guys got together, they lied about the existence of this gold, and then pretended to hire accounting firms to audit that gold. And so they allegedly pumped the token from May of 2018 to January with false and misleading press releases and a bogus press conference. And so they're hitting them with charges of violating federal securities laws, specifically the anti-fraud and securities registration parts. So they're looking for permanent injunctive relief, disgorgement plus prejudgment interest, and civil penalties against all of the defendants. And more harshly, in addition to that, they want the individuals involved to be permanently barred from ever being an officer or director at a publicly traded company ever again. The global NFT market cap is down 0.53%. Sales volume is down 5.7%. According to CoinMarketCap, the top 5 NFT collections by sales volume are CryptoPunks, followed by Otherdeed, Bored Apes, Mutant Apes, and CloneX. Now keep in mind, some of these collections have very volatile prices, so do your own research. On September 15th, Celsius's legal team filed notice with the U.S. Bankruptcy Court for the Southern District of New York. They were asking for permission to sell around $23 million worth of stablecoins. This is due to be heard on October 6th. That doesn't sit well with Texan regulators. The Texas State Securities Board and the Texas Department of Banking submitted a joint filing. They note that there are more than 40 states investigating Celsius for their actions from before the bankruptcy filing. So this objection doesn't have anything specifically to do to the bankruptcy itself, but Celsius's actions. See, they had a problem with Celsius. They're concerned if Celsius sells off their stablecoins, they're going to they'll resume their non-compliant offerings in Texas and Vermont. Yeah, Vermont's upset too. It's a problem because Celsius never registered with the state security boards. One of their concerns that they have, Celsius hasn't said what they're going to do with the money. In their objection, the Vermont regulators note, quote, "It is not at all clear what the debtors intend to do with the proceeds of any such sales, whether the relief requested extends to stablecoin-denominated assets, such as the retail loans to consumers, and the degree to which the debtor's use of sale proceeds will be supervised by the court." Texas was more succinct. They said, quote, "Texas is extremely concerned by the debtor's request for an order that allows ambiguously broad authority to sell and or exchange the assets." And so the regulators from both states have requested Celsius's motion to be denied. Texas said that it would, quote, "only act to confound the examination and further muddy the already opaque waters that are the debtor's cryptocurrency assets." That said, Texas was also talking about what happens if the court grants Celsius's request. They said, quote, "Relief granted to the debtors should be limited to selling stablecoin and holding the proceeds of such sale solely for the benefit of creditors of the bankruptcy estate." Earlier this month, the Bankruptcy Court of the Southern District of New York granted a motion for Celsius. They're going to appoint an independent examiner to investigate aspects of its business. Keeping with that topic, Celsius is looking to recover some money of their own, money that they say that they're owed. They subpoenaed Equities First. This is after the former CEO, Alex Mashinsky, said they had borrowed money from Equities First. And as should happen, Equities First collected collateral from Celsius to cover the loan. Apparently, Equities First can't cover it. They don't have the collateral to return. So Mashinsky is saying that Equities First owes Celsius some $439 million. Now, the subpoena part is part of that process. They're demanding any information on the loan agreements between Equities First and Celsius, any records of any transfers of cash or crypto between the companies. They're also looking into the reason why Equities First can't return the collateral. As we like to do on the show, let's take a look at the numbers. At the time of writing, Celsius's native token CEL is down 3.88% in 24 hours, which is sharply different from the kind of flat motion the market has had mostly today. It's trading at $1.40 each with a fully diluted market cap of just under $1 billion. I think that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. Take care of yourselves, but take care of each other too. We'll see you tomorrow night.